Venezuela only runs at about 1% of the output on oil and energy that it could have. They've got some of the largest proven reserves. And if you're not familiar with how to think about oil and oil production, proven reserves, it's a 90+% chance you can get it out of the ground. So 200 million at 90%, those are great odds. On top of that, you've got a really strong energy infrastructure with relatively modern pieces implemented into the grid. When you look at their energy production from an electricity standpoint, they have some of the latest and greatest General Electric and Siemens electrical turbines that they just aren't using to produce electricity. So there's kind of this undercurrent that you could think about with Venezuela, where not only we're going to get raw, heavy crude oil out of the ground to refine, but what if we could also move some of these data centers that people are talking about building in your various backyards, move those to Venezuela, turn on these electrical turbines, and have these large AI data processing centers in a friendly state with pretty cheap energy. Well, how does that change the equation?
Thanks for tuning into On Target. I'm your host, Matt Tarka, partner at Concentric Wealth Management. Before we dive in, a quick reminder. Today's discussion is intended for educational purposes only and is not intended as investment advice. You can find our full disclosures at the end of each episode. Let's go ahead and get started.
Again, welcome very much to On Target. My name is Matt Tarka. I'm your host, partner, and director of portfolio management here at Concentric Wealth Management. Very excited to share this adventure with you and give you more timely commentary and insights into our thinking on both markets, business, the world, and pretty much everything. So let's start off our first segment here talking about the market's economics and what's going on. On a year-to-date basis, the S&P 500 large cap index is off about 1%. Is off about 5% from its all-time highs. What's interesting here is that earnings have been pretty strong. The only thing going on right now, well, the only thing is maybe an understatement, is geopolitics and the effect that might have on inflation, which we will tackle here in just a couple minutes. Mag 7 earnings on a quarter-over-quarter basis came in at about 27% earnings growth versus the S&P 493, we'll call it, not the Mag 7, not the Amazons, the Nvidias, the Teslas, the Googles, Microsofts of the world. The earnings growth quarter over quarter on those was about 9.8%. Moving along to the S&P 400 mid-cap stock index, it's up about 3.6% on a year-to-date basis. S&P 600 small-cap index is up about 3.5%. International developed markets, Europe, Asia, Far East, it's been volatile over there. They've pulled back sharply in the last couple weeks here, and they're up about 3% on a year-to-date basis. Emerging markets on a year-to-date basis are up north of about 8%. The 10-year Treasury is flat on the year after having a really strong February and January. Gold continues to be a strong performer and is sitting at about $5,000 per ounce, and oil has been volatile. Not that we always joke, not that there's anything going on in the world right now, but oil is sitting about $97 per barrel, really from geopolitical concerns and what's going on in the Strait of Hormuz, which we're going to tackle here in a couple minutes. But oil, your staggering statistic of the day, has rallied nearly 67% on a year-to-date basis. Truly incredible. Some bright spots this year in equity markets have been natural resources, energy stocks, industrial stocks, real estate stocks, utility stocks, and kind of the more defensive side of the equities. The growth side of the equities, technology, communications, healthcare, they've been softer this year as the market is curious and really starting to wonder what kind of earnings growth they can continue on. Value side of the equation has been in favor, whereas growth has fallen slightly out of favor this year. We've had some recent unemployment data get released where the economy lost 92,000 jobs and the unemployment rate edged up to about 4.4%. In the same time period, economists were expecting a job gain of about 50,000 jobs. On top of that, we had a CPI report, gets Consumer Price Index report released this morning on Thursday, March 12th. And that remained steady at about 2.4% year over year, which is pretty much exactly what was expected from economists. The real question now is, where does inflation go from here with oil hovering in this $90 to $100 per barrel range? And markets are reading and reacting to that. What does that do to inflation? What does that do to consumers? What does that do to the overall spending that they have? So now to talk about the two hot topics of the day that we're getting a lot of questions about: artificial intelligence and geopolitics. want to start with artificial intelligence. And I think it's kind of important to define what artificial intelligence, AI, is and is not. To start with, it's software. This is software designed to perform tasks with certain levels of human cognition, but it's not capable of independent reasoning and can't be audited. So there's the pro, there's the con. It's great at pattern and prediction recognition and really just general purpose productivity, but it can't produce instant productivity gains. You have to build this into workflows and you have to embed this. So with artificial intelligence, the real question in lies, what's the long-term adoption curve of it, right? Where is this going to have a true effect on business? I think on our tax side of the business. So, I'm obviously on the wealth side, Concentric Wealth Management, but we have a tax practice, Burke CPAs and advisors. We can't use AI meaningfully in that space because we can't trust that if you give it personally identifiable information, PII, that it doesn't do something with it that it's not supposed to. So we don't. The only AI we can really use it for on that side of the house is researching different tax codes and workbooks and laws and stuff of that nature. That's what AI is good for right now. When we think about where the market is headed and where the market's reading and reacting to artificial intelligence, you're seeing companies across the board thinking about and or deploying and or investing in artificial intelligence. But where are you actually going to see the gains from? That's, I think, where you're going to start to define winners and losers from this AI race. It's not who just throws money into AI. It's who meaningfully changes their workforce from AI. Is it video companies? Is it audio companies? Is it the changing of text, images? There are so many companies that are trying to integrate these co-pilots into their workflows, but very few have been successful at it. So very candidly, at the same time, I kind of view AI and we kind of view AI at the same juncture that Bitcoin was, call it 2017, 2018. It's just not generally regulated. Before Bitcoin was regulated, we're gonna jump a rail here. Before Bitcoin was regulated, no one really knew what it was, how it was taxed, how to use it, how to think about it, right? Then regulation came out in the United States and abroad and said, here's what Bitcoin is, here's how we think about it, here's how we want to regulate it. AI, I think we're going to think about AI very much the same way as Bitcoin, in the sense that we're going to need some level of regulation to put the guardrails on, to snap that chalk line, to make sure that it's a safe, transparent, and system that we're using as we're training models and as we're thinking about implementing it on this kind of frontier technology basis. And also, how do we export it to make sure that it doesn't fall into the hands of bad actors? From a market's perspective, AI has been very interesting because there's this overwhelming expectation that AI is going to automatically make life more efficient. And to an extent, it makes things simpler. We use AI every day on our side of the house, Concentric Wealth, to help out with simple marketing things. It's the theory of I can sit all day and we can sit around a table all day and stew about how to write an email opening paragraph to an email blast, but it's not the best use of our time. So having a piece of software that can go in and make something that is decent, right? Maybe a high school level, but is an email opening that maybe 10 to 20% of people are going to read. I think that is where it saved us a lot of time as a firm. In addition, we use AI-driven note takers, which then feed into our client relationship management system, our CRM system. And, we're exploring different ways we can use AI. As we get statements in, how can we make it so that we're not spending as much time putting data in, but providing our clients with better outputs, with more complex solutions that are more tailored to them? That's really where AI is going to add value in. So this question comes around of, I'm going to call it productivity optimism. Businesses have this overwhelming sense that you're going to be able to reduce workforce, reduce capital spend on humans, increase capital spend on technologies, and somehow instantly unlock a bunch of time that they haven't previously had. And that, I think is a little bit short-sighted, because you got to realize AI, as I mentioned before, it can't be audited. It doesn't have cognition. It doesn't have the same thought process that a human does. You start to type a sentence and it responds and says, well, Matt asked me, what is a podcast intro? So I'm going to start with and then I'm going to go to the next word. I'm going to search everything in the universe I possibly can and come up with the next word, podcast. And then I'm going to do that again and come up with the third word, into infinity, until I've finally reached the end of an answer in a format that I believe, this is the AI talking, right? In a format that the AI believes is the optimal output for the question asked. So it's not going to take jobs tomorrow because it doesn't have the same cognition. On top of that, think about it. The last time that you had an issue while you were flying or had an issue with a bill, I'm sure you called into a help desk, and that help desk probably had an AI assistant. Hi, my name is Betty. How can I help you today? And you inevitably gave it some prompt, and it didn't get you to the right place. And eventually you just started yelling at your phone saying, please get me to customer service. Please get me to customer service. This is also why AI is not going to take over, because the candid answer is, when people want to have relationships, they're going to have relationships with people, not computers. It can't replace that human touch and that human element. At the same point, in roles where judgment is required, it can't be replaced either, because you can't audit with that output. When you get the answer out of your ChatGPTs or your Claudes, there's no ability to go in and say where that came from, which gives people some unease. So people still want people, and people still want experts. On the topic of geopolitics now, it's been an interesting year. You've got a lot of different things moving outside of the United States. And, we talked about this in our 2024 market outlook, which I think is kind of interesting. And you can look back on that. That's on our blog, on our website, where we talked about this bifurcating world, where we're moving from the post-Cold War era of the United States and the Soviet Union to kind of like the tripolar world, where it was United States, Russia, and China. And now we've just kind of moved into this multipolar world where everyone's just generally doing whatever they want. You've got the US, you've got Russia, you've got China, you've got Britain, you've got France, you've got Germany, you've got Saudi Arabia, you've got all these countries, Brazil, Argentina, South Korea, Taiwan, Thailand, all these countries that are just kind of doing whatever they feel is best for their own economies and for their own populations. So we're moving to this bifurcated world, and that's adding volatility in the sense that the same old is kind of out the window. So on the note of China, it's been interesting. This is a country that's been growing at nearly double digits for the last 10, 15, 20 years. And they came out and they revised their 2026 economic growth target to 4.5% to 5%, really reflecting weak domestic demand and all these ongoing trade tensions that we hear about. At the same time, they're increasing their defense spending and emphasizing technological self-reliance, which is the first time that we're hearing about that from the Chinese. Historically, they've been a net importer of technology from the United States. And part of that, they've gone in and there's cases after cases after cases where they've copied the intellectual property of the U.S. company to reproduce in their own country under their own brands. And now you're seeing this stark shift out of Beijing, where they're saying, we want to develop our own stuff in-house. We want to be a net exporter of both goods and services and intelligence. We, the United States, are a net exporter of services, and we're a net importer of goods. We just don't produce as much as we consume, obviously, and probably naturally. I'm sure that's not a shock to anyone. So China is having this demographic shift where the younger generations no longer want to work in the factories and be construction workers. They want to have kind of what I'm going to call the fun jobs. They want to be the financial advisors. They want to be the lawyers. They want to be the podcast hosts. They want to have all of the experiences similar to their American middle class counterpart had 30, 40 years ago. It's very interesting. There's this whole subgenre of music that's come out that is Chinese bluegrass. It's actually wildly entertaining to listen to as a bluegrass fan myself, true Kentuckian here. The cultural shifts you're seeing in China are incredibly stark compared to the hard line that the government puts across from China. And I think that we're seeing some faltering in that system. The days of true communism have gone out the window in China, and they've embraced this kind of quasi capitalistic society where they want to be controlling of certain aspects through state run companies, but as a whole, they're trying to stimulate economic growth. They're kind of in the middle of slash coming out of a long winded, great financial crisis style event where the real estate and insurance markets and financial markets all but imploded. Real estate, in most cases, actually did implode, and they actually had to tear down uh, a great number of buildings. But nonetheless, China is also in a bit of a pickle right now with everything going on in Venezuela and Iran. These are two countries that they've historically bought energy from at steep discounts relative to market prices. So now they're having to navigate these pressures from Washington, not only on trade tensions directly against them, but from these proxy tensions through not being able to get cheap energy. Elsewhere, we're going to move on from China now. Elsewhere in several other emerging markets, there have been these massive flashpoints that have happened. Venezuela, obviously, the dramatic U.S. military operation earlier in the year that resulted in the capture of President Nicolas Maduro and the installation of this interim government, raising questions over the sovereignty and regional stability and really what the future of the country's vast oil reserves are. Venezuela only runs at about 1% of the output on oil and energy that it could have. They've got some of the largest proven reserves. And if you're not familiar with how to think about oil and oil production, proven reserves, it's a 90+% chance you can get it out of the ground. So with 200 million barrels of oil that are proven, we have a pretty good shot at getting that out of the ground. When you start moving into suspected amounts of oil reserves, the numbers get a lot bigger, but the ability to get it out of the ground gets a lot harder. So 200 million at 90%, those are great odds. On top of that, you've got a really strong energy infrastructure with relatively modern pieces implemented into the grid. When you look at their energy production from an electricity standpoint, and this is where it gets interesting with the AI-1 too, we're going to go on this rail in a second here. They have some of the latest and greatest General Electric and Siemens electrical turbines that they just aren't using to produce electricity. So there's kind of this undercurrent that you could think about with Venezuela, where not only we're going to get, raw, heavy crude oil out of the ground to refine, but what if we could also move some of these data centers that people are talking about building in your various backyards, move those to Venezuela, turn on these electrical turbines, and have these large AI data processing centers in a friendly state with pretty cheap energy. Well, how does that change the equation? And I think that that's a big question that the markets are maybe waking up to at this point. On top of that, we had a strike on Nigeria. It's a very important strike because Nigeria is a great ally to the United States and Africa. And we went in to clean up some of the holdover ISIS cells that were left in Nigeria after 2019, 2020's instability in that country. We want to show that we're a good partner to them, and Nigeria being a key player in Central Africa makes it very powerful to have them on our side. There's been talk that the Chinese Belt and Road Initiative is focused in specifically on Nigeria through foreign development, not really foreign investment, not really through cash itself like the United States has historically done, but through goods and services. So think the Chinese are going in and building roads. They're putting houses in. They're adding air conditioning into houses. They're doing the I'm going to call it the hard tangible side of the equation as opposed with the soft dollars like the United States has done, which obviously for U.S. domestic or for U.S. foreign policy, it is detrimental when we get the Chinese involved generally in these markets that we're trying to be the key ally in. Now for the big one, Iran. Beginning of February, markets started to step back. They started to say, hey, just what if we go in and we take military action of some capacity in Iran? And we did. We did just that. We went in and had a strategic military operation taking out most of Iran's top leadership. What the result of this has been is what I believe to be, and what we're surmising to be in our investment committee, probably an extended conflict. We don't think this is going to be Iraq 2.0. I really want to lead with that. We do not believe this is going to be an Iraq 2.0. We think we're going to be in it for the mid-run here. You know, depending on what news channel you read, some people think it's going to be 2 more weeks past this point. Some people think it's going to be 6 to 8. Some people think we're in an Iraq 2.0. I really do not think we're in an Iraq 2.0. There's no indication that we're in an Iraq 2.0. We don't want to put boots on the ground. That's been clearly communicated. So I don't think that that is the worry. But I think the worry here is if we have this protracted regional conflict, what does that do to commodity prices? What does that do to the price of oil specifically? And we're seeing it, and we saw it coming out of this past weekend. You know, oil spiked overnight future sessions to $130 per barrel. At that level, that adds a full 2.5% onto the consumer price index inflation reading. So we'd go from 2.4% to potentially 3.5% to 4% on inflation in that case. Oil hovering around $90 to $100 a barrel on a long-term basis can add about a 0.5% to 1% of inflation onto that CPI index. That's causing the markets to step back. And I mentioned this at the beginning of our episode, but that's causing the markets to step back and ask the question of what happens if we get extended conflict and we have further inflation? What does that do to the Fed's logic? What does that do to rates? How does that affect the 10-year? So what we're seeing is we're seeing a safe haven asset rally. Gold, the US dollar, and short-term treasuries have been incredibly strong since the start of this conflict. But what we're seeing is a rotation out of what I'm going to call these risk assets, growth equities, things that can be quickly consumer discretionary in most cases too. Things where either the consumer drives a lot or that a lot of the thesis of these stocks has been that rates will come down, which will improve their balance sheet. That is going to drag on markets probably for the short term. Could we see a little bit deeper of a pullback? Absolutely. When I think about a pullback, though, I look at this as being a positive thing. This gives us opportunity to do 2 things. Either 1, deploy cash that's been sitting on the sidelines, or 2, take tax losses where we can. This is really, it's a twofold thing. We want to be strategic and tactical. We're seeing that this is changing on a minute-by-minute basis. I almost feel like that's an understatement. It feels like every 30 seconds there's a new piece of news that's coming out that's pointing things in one direction or another. And I think that we're going to have to see, to get past this conflict, and this is the other question we've been getting a lot, is how, Matt, team, how do we get past this conflict? And that's going to be 3 things. 1, you just have to see general de-escalation. You know, how does this not spill over into this long-term protracted conflict? But how does this not also pull in Bahrain, the United Arab Emirates, Jordan, Saudi Arabia, Kuwait, Qatar? How does this not pull these countries in on a broad basis? So we have to see broad de-escalation. We have to see the number of missiles stopping. I think the other part too is that these other countries are going to raise their hand and say, hey, we've got a lot of oil. We want to get our production back online. We got to open the Strait of Hormuz. So we have to have some sort of deal brokered where maritime assets aren't becoming targets. That's a very, very important thing because that's what's going on right now. That's what's causing oil to spike. 20% of the world's oil flows through the Strait of Hormuz. So getting that back online in 100% operational capacity is very, very important. You know, Lloyd's of London insurance premiums are just absolutely unbelievable right now on ship insurance, to the point that the U.S. Navy's come in and said, hey, we'll start to guide ships through. But I haven't seen that quite happen yet. We are starting to see ships move through again, so this is a positive sign. And it's actually very interesting because they're actually flagging themselves as destined for Chinese destinations, which is funny. You know, no one wants to, the U.S. Navy doesn't want to do anything if something's destined for China. There's kind of that funny juxtaposition. Again, that still talks about this multipolarization of the world where everything's just kind of working in different directions. But I think the other part too is that we're going to have to step back and say we're okay with whatever regime comes in Iran. And this is an important one because we're probably going to have to understand that the nuclear ambitions of Iran, they're going to be there, and that we have to coexist with that potential. So that's our whole episode for the day. I'm going to close with this thought. As investors, it's super easy to get caught up in the speed that the world changes, that the way technology changes. You see headlines and they seem to rotate not every 24 hours anymore. It seems like every 6 to 12 hours you've got a new headline. History suggests, though, that markets are remarkably good at reading and reacting to any sort of change that comes their way, including these major structural shifts. You saw it in the Industrial Revolution. You saw it during electrification. You saw it during the birth of the internet and other transformative technologies that are sitting out there that have tended to create this kind of uncertain short-term period, but have created opportunities over the long term. Our key takeaway here is that innovation typically expands the economic pie rather than shrinks it. If you think about it this way, 6 out of 10 jobs that exist today did not exist coming out of World War II. That's what technology does. It doesn't shrink things like companies and industries. It expands them. It expands the ability to do more productive work. The most important thing is to keep perspective. Markets are going to go through periods of enthusiasm, skepticism, volatility, and as these changes evolve, you have to understand that long-term economic growth has been consistently driven by productivity, innovation, and human ingenuity. We're seeing AI is likely another chapter in that story, and businesses that learn how to harness these tools will effectively drive the next wave of growth. And diversified investors will who stay disciplined through that noise will be the ones best positioned to benefit from long-term trends. Periods of volatility stemming from geopolitics, it's inevitable. But focusing on long-term goals is what's most important. So I'm going to close on this. If you're a client and you're uneasy about the situations going on in the world, the new technologies, we encourage you to reach out with your questions or concerns. Our role is not only to manage portfolios, but it's also really to provide clarity and guidance as everything evolves. And on this note, if you're not a client, please feel free to reach out to us. We're always happy to give a complimentary portfolio review and a complimentary financial plan. We're always happy to give second opinions and insights. So again, thank you for listening and have a great day.
Please stay tuned for all of our disclosures. Securities and advisory services are offered through LPL Financial, a registered investment advisor, member FINRA, SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations to any individual. To determine which strategies or investments may be suitable for you, please consult the appropriate qualified professional prior to making a decision. Any guests and their companies on this show are not affiliated with or endorsed by LPL Financial or Concentric Wealth Management unless otherwise noted. Individual tax and legal matters should be discussed with your tax or legal professional. Any economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical, and there is no guarantee of future results. Any indices mentioned are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.